covered call trades versus the cash secured naked puts, where we have the weekly picks of the day for the covered call positions. And this is just a quick view that's updated, in the afternoon. The weekly covered call picks of the day are updated at 1:01 p.m. Eastern time. And these are based on Ernie's testing, where he was challenged by a subscriber a few years ago, saying, well, you have this search tool and you have this, but where would you start if you were doing a monthly covered call or a weekly covered call position? And Ernie said, well, that's sort of what the default criteria are. He says, well, what is your best criteria? So Ernie knew what his ideas were for a weekly or monthly covered call that he'd like to see, but he went back and did rigorous testing and some actual trading, of course, as well. So probably about 75 to 80 different iterations using the search tools for stock criteria and option criteria to see which mix of criteria perform the best over time. Of course, you can click on see how we develop these results, and it gives you a full insight, the market conditions during the testing period, what the success rate was. 77% of the trades out of 104 total. Average return was 2.3%. Average loss was 3.2%. What were the structures that were used? And long story short, what it comes out to be is that the in-the-money weekly picks of the day here, are slightly in-the-money covered calls. It tends to work out better over time. You get better downside protection in adverse markets, and you have a higher probability of getting assigned and earning the return on a more consistent basis. Whereas buying the stock at, say, 36.69 and selling the 40 strike call for 30, 40, or 50 cents is more speculative. You only get about 40 cents or so of protection if the stock falls in price. Yes, you could still roll down, but you could roll up or down in the money covered call as well. But you have a lower probability of earning the return, the speculative return, if the stock moves up above 40. Having the stock move that much in that 6 or 7 day period to try and shoot for that higher return. If you're in a raging bull market, yeah, sure, out of the money covered calls might outperform the in the money. They probably would. But if you're in an uncertain market conditions and volatile market conditions, it's better to have more of that downside protection in place with the in-the-money covered calls. And these are stocks you're not looking to hold long term. Where I'm going with all this is that, the naked put is essentially a parity trade to the covered call if you're comparing the same strike prices. I buy a stock, I sell a slightly in-the-money covered call, hoping to get assigned, similar to the 3 we just saw in the picks of the day. I have a capped gain to the upside if the stock's anywhere above my short call strike price, and I allow assignment to take control. And I've given myself a little bit of hedge against buying the stock, but the hedge I have is only equal to the premium I'm collecting against the stock price. Well, the naked put structure is the same. It's a parity trade, has the exact same risk reward profile. So if I'm comparing an in-the-money covered call to an out-of-the-money naked put, we essentially have the same risk reward profile, although we have different obligations to meet. We own the stock and sold a call below the current stock price, the in-the-money covered call, which obligates us to deliver shares of stock we own, that strike price. With a naked put, we're likely selling an out-of-the-money put option that's below the current stock price, and as long as the stock stays above that price, the put expires worthless, we keep the premium. But if the stock falls below the put strike price, our downside protection or percent to break even is the put strike minus the credit we took in, but we may be forced to buy shares of stock at that price. Depending on the decline, that might be a negative view. Of course, the weekly picks of the day, we see Cassava, XPeng, and Sentinel. But let's just go back to the covered calls. We have Coinbase, different structures Ernie found. Although they're parity trades, Ernie found that different criteria worked better for the naked put approach versus the covered call approach. There were some differences in what he found. But let's go to the main search for our picks of the day here, the weekly picks of the day, the weeklies. This gives us more of an updated list. So we may still see there's Cassava, of course, and there's Palantir, Coinbase, and so forth. There's the Iminevent, it was in there, and there's XPeng, which was in the naked put. Well, let's take Cassava here. This is the covered call now. That's at the top of the list, recently updated at 4:25 p.m. Eastern Time. Buying the stock at 1906 and selling the 18 strike call for a midpoint of $1.36. Let's just take a look at the profit and loss chart for that position. It's a 1.7% return with having a high probability of the stock remaining above the $18 strike, about $1 in the money in this case. And if we get assigned, it's a 1.7% return for 7 days. Now, the parity trade to that, of course, would be if we sold same expiration, 18 strike put, which currently has a bid of 10 and an ask of 58. So we're $1 in the money here on the covered call. At midpoint, if we take out the intrinsic value, we're looking to make a premium of 30 cents max, which is 1.7% against the total cost basis. If I just sold the cash secured naked put and got near that midpoint price, we're looking at potentially a 34%, my apologies, 34-cent premium with a 1.9% naked yield against the potential put strike price or cost basis if we're signed on the put. So the question that came in when comparing all things considered, if I'm comparing an in-the-money covered call to an out-of-the-money naked put, should I always go with the one that has the higher net premium? The answer is yes, because if you've liked the stock, and this is not, of course, a recommendation or suggestion, you want to do your own due diligence there for Cassava, but if you like the stock, you like the trend, you've decided it's a covered call you want to use, I will always try to compare it to the parity trade if I think I can get that premium. Here's where a dilemma comes in for me. Let's go to the option chain for Cassava, just for the 6th of October, not the 6th, my apologies, the 13th of October expiration. Hey, Friday the 13th in October, how spooky is that? But I want to go to the option chain, and we're going to look at calls and puts for just next week. Now, I hopefully have this set up correctly the way I want. So the option chain here is a good place to allow you to compare. There it is. Okay, good. To compare the two different positions and evaluate. Sorry about that. And why that's important is here we see the premium of 136 on a stock that's 106. I'm sorry, the option strike that's 106 in the money. So we saw that the max premium was 30 cents. Now the bid's 123, the ask is 149. There's some good open interest on this position. We could look at the volume real quick. I just don't have that selected. Then we go to the put side, and the bid's at 10, and the ask is at 58. And there's only 62 open interest. That's still not bad. There's probably some volume on it today. But percentage-wise, this is a much wider bid-ask spread. What I mean by that is that looking at this, I don't think it would be too out of bounds to get 136, maybe 135 midpoint if I entered the covered call by selling slightly in the money 18 strike. It's a 26-cent bid-ask spread. So getting 10, 12, 13 cents up to 136 I think is plausible. This is only a 48-cent bid-ask spread. It's not much more. It's double, essentially. Almost close to being double, but it's a 48-cent bid-ask spread. My fear here is that even though the naked put would give a 34-cent net credit, which is greater than the max profit we could receive if we got midpoint on the covered call, I'm more hesitant to believe that I could get this 34 cents premium on the cash secured naked put. My fear is that if I put in an order to sell this at 34 cents across the exchanges on PowerOptions and on my broker, I'd immediately see the bid-ask change. How would I see it change? Most likely what I'd expect, especially if volume's low that day, is that if I put the order to sell to open this at 34 cents, with this wide of a bid-ask spread, mind you, that I'd suddenly across the exchanges in my broker, and you'd see it on PowerOptions in real time too, that the bid would remain at 10 cents, but the ask would now drop to 34. The market maker, electronic market maker, is trying to get me closer to this 10 cents. He's going to want to see me at 19 cents, maybe 18 cents, maybe 20 cents. I don't know if I'm going to get the 34 with this wide of a bid-ask spread, especially since it's double what it is here with the in-the-money covered call. So I just wanted to bring this up because the idea is, well, if you're comparing two parity trades, an in-the-money covered call versus the out-of-the-money naked put, And you see potential for a higher return, a 7-14-day trade. We're comparing a 1.7% yield for that in the money covered call versus a 1.9% return on the naked put if we get the midpoint price at 34 cents. That's where I have the dilemma. So even if here you can see if you got filled at the bid point, I'm sorry, the bid price, this would be about a 17-cent maximum profit at 123. I'm always shooting for the midpoint when I enter credit spreads, weekly covered calls, weekly bull put credit spreads, things of that nature. I'm always starting with the midpoint, and then I'll move it down if needs be. But if I'm moving it down too far, I might just go into a new position, look at the next position on the search tool that matches my criteria, rather than keep trying to fight the market maker to get a return I was not looking for. If I can get that return on one of the other positions I also liked from the search results. And here, if at just at bid, I'm getting 17 cents here, it's still higher than the bid at 10 cents here. So that's another factor that you want to take into consideration. It's not just the best return at midpoint, where we're seeing it was on the cash secured naked put, but that next level of thought you want to consider, the likelihood of maybe getting this midpoint compared to getting this midpoint. And if you just got filled at the worst case scenario in both positions at the natural bid price across the market, which one's giving you a better return? Both of those answers are over here, even though in this one example only, this particular example on this particular stock, this particular expiration with this 18 strike, although the naked put is showing me a better premium at 34 cents, higher naked yield, I'm not as confident that I could get that midpoint. I might try to enter it, but again, even just seeing that the natural bid across the market is much lower than the max profit I'd get at the bid here. This is 17 cents versus 10 cents. I'm still leaning more towards attempting the covered call and trying to get filled at 136. More realistic potentially. Pros and cons aside from that, of course, based on what you're doing in your portfolio, what's allowed in your portfolio, your preference of cash secured naked puts over covered calls, but just a direct comparison of, hey, there are parity trades. Shouldn't I always go with the one that's giving me the best return potentially? My answer is yes. But you've got to take that next level of consideration just looking at it. Consider the worst case scenario if you just got filled at the bid, which one's giving you the better return? And what is your thoughts on the consideration of the likelihood of getting the midpoint when comparing the parity trades? Because it might not be as likely that you're going to get that. You may be better off just going into the other position that has a better chance potentially of getting filled near the price that you want.